Okay, good morning and welcome back everyone to 2021. We've had a pretty jittery start to the markets this year, so let's talk a little bit about where we currently sit, how we're currently viewing the equity markets and fixed income markets. We've seen some big movements in gold and silver and some of the other commodities. So we'll review all of these things along with economics and some of our ideas for today to help you better understand how to position for the current market that we're currently sitting in. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off with our normal market update just to give you a sense for where all the broader equity markets are currently sitting. Then we'll talk a little bit about commodities and rates and talking a little bit about how the dollar has responded and what we're starting to see in commodity markets, as well as some of where the global markets currently sit. We'll take a look at what sectors are currently moving, what sectors are gaining relative strength, which sectors are losing relative strength to give you a sense for where that sector rotation is currently happening. I do want to take a look at economics a little bit here, looking at manufacturing, giving us a better understanding, especially in the explosion that we've seen in retail sales. Some of the manufacturing data is starting to be concerning to us with respect to supply. So we want to talk a little bit about that and what our expectations for retail going forward as a result. Also, employment remaining fairly concerning here and consumer confidence taking a hit here at the end of the year. We want to make sure we take a look at that going into 2021 and then sharing with you our ideas. And at the very end, if we have a few minutes, we'll open this up for Q&A. But the primary question that I want to help investors answer is really the one that is, I think, at the forefront of most investors after yesterday's price action, which is, are markets starting to roll over here in 2021? Have the number of coronavirus cases finally caught up here to the equity markets, and the markets finally responding to this, to the rise in COVID cases? So my name is Tony Zhang. I'm the chief strategist here at Options Play, and what I want to do is I want to help investors better understand how to utilize the technical analysis and charts and economic data to help you inform your trading decisions. So let's start off with SPY, the S&P 500. We had a pretty violent day yesterday, intraday down more than 2% intraday, but by the end of the day, we came back to basically close at the 21-day moving average. So despite the fact that we've had a pretty volatile day, in the grand scheme of things, we're still pretty much in this uptrend that is still intact. We've gotten the pullback to the 21-day moving average, which historically have been opportunities to buy. And we really do not think at the moment that what we're seeing right now is any different. A lot of these the selling that we saw here yesterday were on stocks that have performed very well here over the past month. So a lot of profit taking from investors yesterday rather than necessarily a big sell-off per se. Especially if we look at the NASDAQ 100 index, NASDAQ is still remaining above right now the September 2nd highs. So the NASDAQ 100, remember, took a much longer for it to get back above those September highs, but now holding those levels again, higher lows, back to the 21-day moving average. And this, again, potentially is an opportunity to consider going long again. If you look at IWM small caps, same thing. Small caps did manage to make a lower low here from the lows from last week here. So this is one that we're going to watch to see if small caps can hold this 192 level here. If it can hold that level, we certainly expect it to continue to moving higher. I do like the fact that IWM, which has been so strong here, has taken a little bit of a breather here because that's it's not healthy for markets to just march straight up, straight on higher. You need a consolidation period. You need a rest before it can continue moving higher. I don't particularly think that this pullback was particularly deep, if you will. I'd actually like to see a little bit more of a give back before it continues moving higher, or at least a more of a consolidation period before it starts to move higher to confirm that move higher. But small caps remaining very strong. If you look at value versus growth, value is still performing on par with growth here at the moment. So it's not like growth has come back into dominance in terms of performance here. The two are very hand in hand at the very moment. So IWM strength so far is intact, but if we do see this start to break down further, then we may see growth start to outperform value. When we look around the globe, EEM continues to outperform here. This is one that I've been talking about for quite a few weeks, expecting EEM to outperform US domestic equities. And this really comes down to the region exposure that you get with EEM, which is predominantly in Asia Pacific, and the specific sectors that you get exposure to, consumer discretionary, technology, and financials, which have all been very strong in those particular regions. So EEM making new all-time highs here yesterday, and our expectation here is for EEM strength to continue here. The one thing I want to point out here is that EEM has hit our $52 target here to the upside. We've now broken above that target. This is really where, if we see a continuation here above 52, this really could extend targets much, much higher here for EEM. So we are at a pretty pivotal moment here for emerging markets. We did see VIX spike here yesterday up to that 28% range, which is the upper end of the range of our new volatility regime. Our expectation is for VIX to be somewhere between 18 and 28 going forward here, now that we have a lot of uncertainties taken out. I will say the new strain of COVID as to how that's going to play out here in the number of cases, in how vaccines respond to that, that does add a new level of uncertainty to the picture here. So we may have to adjust our volatility models a little higher here, but right now we're certainly at the upper bound of that range. So we're likely to see some volatility selling as we get near the top of that range here. So that's where we currently sit from a volatility perspective. And then the dollar, we've seen dollar continue to slide here. We've been talking about this dollar slide here for multiple months now, whether you were long the dollar, short the dollar, either by long EEM, whether you were long some of the mining stocks like FCX, or you were outright short the dollar through an ETF like UUP. The one thing that I want to point out here is that we have now reached our targets here for dollar. We're back near what is a major support level that we haven't hit since April of 2018. Now, the question is whether this continues to move lower or not down into the $80 range here for the dollar. Now, a move down to 80 would obviously be a big move here to the downside, and that has major ramifications for assets priced in dollars, whether you're looking at emerging market bonds, whether you're looking at gold or silver. These are all things to pay attention to. So dollar is at a major support level here, and what we have to look at is whether this continues to break lower here. If you look at the size of the stimulus, if you look at fiscal response to the pandemic, this suggests that we could see a breakdown below this $88 level here in dollar and a continuation lower here. And again, major ramifications for assets that are priced in dollars, such as gold, which is why we saw gold take such a big move here yesterday. Now, we had one false move here, in my opinion, of this trend line here. Let me just draw this trend line. We've had one false break here earlier, back here in early November, but I would say now that we've had the second breakout here that looks like it's going to take hold here, I think we can now target going back to this 192, 195 level here to the upside. Now, I don't necessarily think that this move to the upside is going to be a straight shot up. It might be a slow grind higher here, but I do think that we've now completed this month-long consolidation here for gold in this channel, if you will, and have now broken out of that channel, which is a good indicator, if you will, of a continuation higher here. So what we have here on the weekly chart is a strong move to the upside, a flag formation or a consolidation range, and now the first breakout here. So we can now target well into the 200s to the upside in extended targets, but in the short term, at least getting back up to that 192, 195 range here to the upside. Now, for those of you that are trading Bitcoin, similar move, much, much faster than gold here. The one thing I will point out here is we've had this big move here from about $18,000 to about $34,000. So we're talking about roughly a doubling of Bitcoin over the past month or so. So my expectation is that you're going to see a bit of a consolidation here. We've gone a little too far, too fast. Can this continue moving higher? I certainly think there's an opportunity for that, but I think you need to see a little bit of a slowdown here, as we have had some pretty major moves here over the past couple of months. That one that has gone a little parabolic and needs time to consolidate before moving higher here. Now, looking at the sectors, looking at where's their rotation, where's their strength being gathered, and where's their strength being lost, one of the places that we have to look at here is the continued strength of financials. We've seen the US 10-year yields moderate around that 93 basis points, which is where it's currently sitting right now, looking like it's going to make a push for that 100 basis points. We've seen inflation expectations continue to move higher here, which is looking like we're going to get a steepening of the rate curve. So with the reopening of the economy, if you will, the gains that we're starting to see from economics, plus you have a steepening rate curve, this has been bullish here for financials. And that's why we've seen a continued sustained upside here for XLF financials here over the past couple of months. XLF just now within spitting distance of its all-time highs of that $31 level here of XLF. That would be our short-term targets here to the upside. Both momentum indicators on the daily and weekly chart have not reached overbought. Money flow is positive on both the daily and weekly charts. This points us to a fairly bullish picture here for XLF going forward. Another sector that continues to gain a little bit of strength here is XLV. XLV is now contending with this triple top here, if you will, around this 113 level. As you can see, this triple top here at 113, but continues to make higher highs into that 113 level, which leads us to believe that we're likely to break out here to the upside. As you can see also on the momentum side, both the daily and weekly charts still have plenty of room here to grow to the upside before it's overbought, and money flow recently turning positive here on the daily chart, and then money flow on the weekly chart remaining fairly strong. So we're seeing strength out of financials, we're seeing strength out of healthcare, but there is one sector that has been fairly strong that is starting to lose a little bit of steam here, which is XLI. Now, things are not over yet for XLI yet, but we have made a lower low here after consolidating for quite some time here. Now, this low is, in my opinion, can be easily invalidated by breaking back above the $90 level here. So that's yet to be seen, but this is still early days of we're starting to see XLI start to pull back a little here. As you can see, money flow is remaining fairly weak here. Momentum has started to move here to the downside as XLI started trading sideways here. And the question is whether or not this $85 level here will hold here, which was the highs earlier in the year, which it managed to finally break out. So far, it's still holding those levels, so it can continue moving higher here. But this is one that we're going to put on our watch list to see if we're starting to see some rotation out of industrials, which have been one of the strongest sectors since the start of the pandemic, as to what we're going to expect going forward. Out of the other sectors that are still moving here, semiconductors. Semiconductors currently have putting in this double top here around this 220 level here to the upside. Semiconductors remaining very strong on both the relative strength here. If you look at the weekly chart here, extremely strong chart. Daily chart also extremely strong. Consolidating here over the past couple of weeks here, which is, again, healthy for a market that has moved effectively what is straight up for quite some time for it to consolidate, and now looking like it might break out here to the upside. So looking for that 225 breakout here on SMH is another place to look for opportunities here in the current market conditions. So shifting a little bit over here to the economic side of things, one of the things that we have started to see some surprises is on the manufacturing side. Supplier delivery taking a big hit here towards the end of 2020. And this really comes down to the increases that manufacturers are starting to see in their input pricing. This is due to supply constraints. This is due to the fact that it seems like we cannot find enough truck drivers to actually deliver a lot of the goods around the country right now. That's starting to put a strain on the price of materials that manufacturers need in order to produce goods. And this is causing a strain in the supply or the ability for manufacturers to deliver on goods. So if you look at the retail sales side, retail sales has been extremely strong driver of the recovery largely that we've seen in the markets up to the end of 2020. But we heard issues of supplies early in the pandemic, but we're starting to hear and see issues of supply again here at the end of 2020. So this is going to have some impact on certain retailers, certain manufacturers, where some retailers may not be able to get the supply to meet the demand of consumers. And this is going to have some impact, in my opinion, on some retail sales. So this is one that's important to pay attention to. And I think if we start to look at the earnings calls, if you will, from retailers and manufacturers over the upcoming earnings period, this is another thing that we're likely going to see, and an important one for us to understand as we invest in some of these retailers going into the beginning of Q1, is understanding how, if there is any impact from certain retailers based on their supply chain. But this is one that I think is very important to pay attention to if you're invested in that consumer discretionary or consumer staples sector. Another one that I want to point out here is consumer confidence. Consumer confidence continues to deteriorate. This largely is due to the fact that we've seen a rise in COVID cases around the country. ICUs are being overwhelmed in many of the Sunbelt states. Most of the Sunbelt states are now seeing ICU capacity well above 50% here right now. So this is causing regional lockdowns, cities to go back into lockdown, closing non-essential businesses, and so far unemployment remains fairly strong. Unemployment remains fairly elevated is the right word, meaning we're still seeing a fair amount of U.S. citizens, or rather residents here in the United States, claiming unemployment because of the losses that we have seen in the services business over the past month or so. And our expectation right now is that that is not going to ease in the short run. So this is going to put a strain here, in my opinion, on the services business. May have some small bump, if you will, for some of those lockdown stocks. We had news yesterday that UK is going back into fairly restricted lockdowns. The question is whether that's going to continue across the rest of the globe. So far, we haven't seen too much of it, but there certainly are movements in that direction from Japan, from even countries that have largely kept COVID under control compared to the rest of the world. We're starting to see more restrictive lockdowns. So this is really one of the places that we want to pay attention to. So looking at the ideas for here today really reflects a lot of the things that we've talked about here. One of the trades that I wanted to point out here is a cybersecurity stock, as we likely will be working from home for a fairly extended amount of time here. Cybersecurity is becoming more and more of a forefront, if you will, and not an afterthought, not only for businesses, but also for consumers. So Fortinet, interestingly enough, is one of the smaller players in the firewall space compared to Cisco or some of the other bigger players here in this particular space. But Fortinet so far looking fairly strong here. Recently making another crack here at the 150 double top, or rather triple top here that we have seen here. And so far pulling back to that 21-day moving average, or close to that 21-day moving average, and has the potential, in my opinion, of moving higher here. We've seen the money flow move positive here on the weekly chart. The daily money flow remains fairly strong here to the upside. So this is one that has some substantial upside, opportunity, in my opinion here, especially if you look at cybersecurity as one of the top themes here of 2021. Fortinet, in my opinion, one of the smaller players, has some advantages here from that perspective. The other one is in the semiconductor space. NXPI, specifically in autonomous driving and using their chips in electric vehicles. So NXPI really at I would say, the intersection of strength that we're seeing from semiconductors, as well as strength that we're starting to see from automobiles. And this is one that, NXPI has spent a bit of time, NXPI has spent a bit of time consolidating here over the past few weeks here and is starting to break out here a little bit here to the upside. So we're looking for some strength here. Interestingly enough, NXPI was just basically flat here on the day while the market sold off about 2% here. So semiconductors providing a lot of defense here, even during a strong sell-off like we saw here yesterday. So this is where we want to find protection. This is where we want to look for opportunities as are names that are right now still playing a bit of defense here in the weakness that we're starting to see as a result of COVID. And lastly, if we look at the gaming stocks, especially the esports stocks like Electronic Arts, Activision, Blizzard, Take-Two, we're all seeing very similar chart setups here from all of these types of stocks. So we really have a strong fundamental picture because, again, lockdowns are going back into place around the world. We're starting to see, streaming stocks continue to do fairly well, whether you're looking at Netflix or Disney. And gaming stocks really sit at the intersection of streaming and these lockdown scenarios that we're starting to see play out around the world. And we're starting to see Electronic Arts again take on quite a bit of strength here over the past couple of months. We saw the breakout here above 133, which is a major breakdown, if you will, of this downtrend here. Now, the fact that it got back above 133 validated that EA can make a crack here at 147.5, which is the high. And then you have an all-time high here of 150 here for Electronic Arts. So these are the upper targets here that we have here for Electronic Arts, 147.5 in the short term, 150 here to the upside. If it breaks above 150, then you really have a lot more upside here for a name here like Electronic Arts. So with that, that covers what I wanted to share with you here today as far as what we're currently seeing with the markets. We also have the Georgia elections today. Now, we don't expect the results from that for potentially a couple of days. That's why I'm not talking about it too much. Right now, the views for the Georgia elections are potentially, markets have started to shift a little bit in terms of probabilities of potentially seeing a Democratic sweep here. And there are different ways to view that. A lot of investors view that a Democratic sweep would be bad for the equity markets because, we're going to see more fiscal response. But this is really where the markets have been fairly mixed on that. The markets have not been particularly bearish, if you will, on a Democratic sweep. So those are a few other items that I think should be on your radar here for this particular week. So with that, I have a few minutes. So what I'll do is I'll open this up for Q&A. If anyone has some questions, please feel free to type them into the Q&A window, and I'll try to answer a few questions here. Jerry's saying, I'm not getting any love from Southwest Airlines, LUV. Any thoughts here? Any comments here? So for me, LUV, for me, it's important for it to hold this support level here. We did see Boeing start to break down here yesterday, similar price action. Now, from my perspective, below the 21-day moving average is potentially bullish. Now, we did see that the last stimulus did include a bailout for the airlines. Out of the airlines, I think that LUV is my favorite out of the major airlines because they have the least amount of debt. They are mostly they are only focused on leisure travel domestically, which is the type of travel that we expect will rebound quickest out of all the different categories. So LUV, while not giving you any love right now, it really depends on whether you're a long-term or short-term investor in this. Short-term, not great. Long-term, I like LUV over the other airlines. Do you think the political action in DC tomorrow may affect or shake the markets? I certainly think that it will likely cause some short-term volatility regardless of the outcome, whether it's Republican or Democratic, but I think long-term, not a huge view. And either outcome, if you will, I don't think is going to have a huge impact on the markets. I think what's going to have far more impact on the markets are Fed policy, monetary policy. That's going to have the largest effect. If you do have a Democratic sweep, you're more likely to get a larger stimulus bill or a larger follow-up stimulus bill, which may have some short-term effects on the equity markets, but long-term will have more of a short dollar effect. This is some of the things that we talked about here today. How do you see SPY in the next weeks or months? So I think that you're going to see more strength here, in my opinion, on SPY. Now, if we get to a little further higher here, that's when we'll start to get a little concerned here, and we start to get into the 138, 130, 130, 138 levels here. I will start to get a little concerned to see a little bit of a pullback here down into that 135, 130, 360 level here or so. But, you know, there's a lot of things that are still at play. We take this week by week. It's always hard to say, you know, what things are going to look like here, you know, in a couple of months here. But I still think that we're going to likely see slow grinds higher here and followed by more violent moves here to the downside like we saw here yesterday. What are some good names for LI, lithium, NI mining for EV? Raj, I'm actually in the process of doing some research on that at the moment, so I don't want to jump the gun here on that right now. So I'm going to hold off on answering that question until I have a better way of answering the specific companies that I think are best for from a lithium ion and nickel perspective from mining. But FCX certainly would be one at the top of my list here if you're looking at industrial metals. Now, FCX is not lithium or nickel, but I certainly think that from a mining perspective, one to pay attention to, FCX, but specifically mining, there are a couple of lithium mining companies, but I do want to hold off on speaking about any of them until I do a little bit more research. Ray, thank you so much. I appreciate it. There are issues. Any strong bullish? Those are the ones I just talked about, those three, Jonathan. Can you talk about your views of Plug Power? So Plug Power, I quite like here, especially I like the consolidation that we've seen here over the past couple of days, the pullback to the 21-day moving average. Notice how pullbacks to the 21-day moving average historically have been strong buying opportunities. So we've gotten another one here to the upside. The one thing you have to understand about Plug Power is that it is trading at very stretched valuations. Not that the market is paying too much attention to stretch valuations per se, but it does mean that you have some very volatile times. So it looks like we're about to open up just at the 21-day moving average. In my opinion, that is a potential opportunity for a long position here, in my opinion. Can Disney go higher despite the lockdowns? I think Disney is trading purely on Disney Plus right now. I think the theme parks are not really in most investors' mindsets because the growth opportunities in Disney is coming from streaming. And I think for those reasons, they're likely to be supported here for the same reason that you're starting to see, Netflix contend with, its all-time highs around this 560 level here, continues to grind higher here. I think Netflix will continue to grind higher to that level as well. So with that covers what I wanted to share with you here today. Thank you so much. I hope that you guys find this useful in getting you started on your week and understanding how to set yourselves up. So with that, thank you so much. I'll see you guys on the next education session, and I'll see you guys here next Tuesday. Have a great day.